Hi, folks. Dan Bird with the Daily Scan today on Wednesday, April the 9th. And the market flew to the moon. That's where we're headed. Never going to stop. All new highs coming up. No, I'm just kidding. But that's the way it felt, didn't it? Really, really great rally today. Funny how just a little bit of news can make things move like that. I do have a saying based on something like today, and that is news changes everything. And that can happen to the upside and the downside. So let's take a look. What a day, huh? Fun for many, hopefully, except for those that might have been short. But I'm sure everyone had stops in. So as always, I am not a financial advisor, so nothing that I say is meant as a recommendation to buy or sell anything. This is for educational purposes only, and you need to make your own trading decisions. So before I jump into looking at the market and the dashboard, I want to answer a few questions from yesterday's session. I had quite a few people ask me questions, and I think everyone liked the content yesterday, which is great. And if so, please subscribe to the channel and tell all your friends about it. But let me answer a few of the questions. So one of them had to do with 401k choices. And this is something I meant to mention yesterday, and I didn't. I forgot to put it in. But one of the things about 401ks is you do not have many choices. So you have to either be in cash or be into the market of some kind, either the S&P, or they might have a few choices for in the market, like a 60-40 split, 60% equities, 40% bonds, but not too much else. So when you're in or 401k, you don't have too many choices to pick from. So that's the advantage of doing a technique like this. Now, one of the questions was, how do I invest in the inverse ETFs? Well, you can't do that in a 401k. You would have to move things to an IRA in order to invest in the inverse ETFs. And to do that, you would just do a rollover. So I recommend that for anyone that has left a job and they left their 401ks behind. In fact, some people might have multiple 401ks sitting out there. I would highly recommend doing a rollover. So a rollover is a non-taxable event. That means you just move it to another vehicle. So you can move from a 401k to an IRA, and IRAs gives you lots more choices than you can do the inverse ETFs. But in the 401k, you can't do that. And if you're working and your employer is matching 6%, I highly, highly recommend taking advantage of the match. At a minimum, put in enough to take advantage of that 6% or whatever their match is, because that's free money. They will give you money into your 401k. So you definitely should do that. But if you want to move it to an IRA, and if you have left a job and have a 401k sitting out there, just do a rollover. That is a non-taxable event. So another question that was asked is, if they were to execute the strategy that I laid out yesterday and they move everything to cash, does that mean they have a taxable event? And I want to be really clear about this. That is not what I'm recommending, not what I'm suggesting. So the implication in that question is that they thought that to move to cash, you had to liquidate your 401k or move all the money out of the 401k. And when you do that in a 401k, number one, if you're younger than 59 and a half, you will get hit with a 10% penalty for doing so. So you don't want to do that. And you don't want to move it out of the 401k anyway if you're still working, because you want to take advantage of that employer match. Unless you've left a job and you have an old 401k, then you should you should do a rollover to an IRA. But what I'm suggesting is not to liquidate the 401k. It's simply to move the money into one of the vehicles that are offered inside of the 401k. So most companies that manage 401ks, Fidelity is one of the biggest ones out there, they will give you multiple choices. So you have to go into your 401k and see what those choices are. Determine how you can move it to cash. Sometimes they have a money market fund that they'll let you move it to. That's inside the 401k. That's not closing the 401k. That would be a taxable event. It's inside of the 401k. You just move it to a different account, different vehicle inside the 401k. So that might be a money market fund. If they don't have a money market, they probably will have a bond fund of some kind, or maybe even a short-term treasuries fund, which can act like cash, sort of like cash. So you move it out of the market, you move it out of an equity fund, and you move it into either a money market or you move it into a bond fund or a treasury fund, something that looks more like cash than an equity fund would look like. That is not taxable because you're moving it inside the 401k. You're not closing anything. You're just taking advantage of the other options that your 401k provider offers. You just move it to a different option. And that's what I'm talking about with that strategy, just moving it over to another vehicle. Another question that came up was, inverse. They asked about that. You can't do inverses in a 401k. You'd have to move it to an IRA to do that. One good observation was somebody said that I mentioned this is the monthly chart that I showed yesterday, and I was saying that the blue line was the 21. Well, it is now, but yesterday it wasn't. It actually was a 13 moving average. So down here you can see it's a 21. So that was very observant. I wanted to say that I put that in just to see if anyone was listening, but I actually just left it in because I forgot to change it. But it's changed now. So now when you go to the website and you go to the portfolios page and look at the monthly VTI, then what you'll see is the 21 day. So the 50 now, I actually changed that to a red color because if it goes below the 50, that is the secular bull market would be over if it closes below that at the end of the month. This is a monthly chart, so you have to wait for the close. Which brings up another question that somebody asked. Do you wait for the close or do you do it as soon as you see it below the 21, which I think I did cover yesterday. So I'm going to use the weekly chart for this. And I actually will put the vertical lines in there for you, but that does not mean you have to wait for me or you have to follow, what I'm doing. You can do whatever you want, really. You could have moved out just because it's a red bar up here. Now, I like to wait for it to go below the 21. So the question was, do you wait until the end or the close? In this case, since it's a weekly chart, it means you have to wait till the end of the week before the close. On a daily chart, it's near the end of the day. So you can look at it at 3:30 and see if it's going to stay below the 21. But it's really important, especially on a weekly chart, it's really important to not do it when it just goes below, but wait until the end of the week. In fact, the end of the day at the end of the week, around 3:30 in the afternoon, and see if it's going to stay below the 21. And that's why I put this blue line, which represents cash, in here, the vertical line. So that was the move to cash signal. And then the move to short was right here. And in fact, today, actually on the weekly, it is still a short signal. I'll show you that in a second. All right, now let's talk about this a little bit because one of the questions that they asked was, way back, it looked like back in September, it went below the 21, and wouldn't that be a go to cash? And that actually is a go to cash because this vertical line is actually on the chart and it was on there when I did the video yesterday. So that is the go to cash. It closed below the 21. And then the return back to long is when it closed above the 21 right there. So you were out of the market. All right. In your 401k, you moved it out of an equity account. You moved it over to a money market or a bond account so that you're no longer in the market. You're in a cash account, but you would have been there for about 7 weeks before moving it back into an equity account. Look at this one right here in August. Now, if you had just done it as soon as you saw it go below the 21, you would have actually been out probably on Monday or Tuesday of that week. That particular week, it opened way down here. You can see where the open is, way down there. So if you were using that method, then you would have been out right in the beginning of the week and you would have missed this whole run right here. So wait until the close. In this case, it closed on Friday. So it opened way down here and all week long, it just continued to buy. People were buying all the way up there. So wait for the close before you execute. And if you're not sitting at your computer, if you're working and you can't look at the market all day long, then jump in the next morning. That's what I used to do when I was working and I was in a 401k. I would look at it at the close, at night, after I got home, and I would see, oh, looks like it closed. And now remember, this is on Friday, so this would be Monday's open. So Friday it closed above the 21. So Monday morning, I would put an order in and it would execute right there. There's the open Monday morning, a little bit higher, but not much higher. And then you would ride it all the way up until this blue vertical line. That's the go to cash, this whole period here. So that's actually, you wouldn't have even have been out right there because you would have got in way back here. So that was about a year and a quarter. You would have taken advantage of long-term capital gains. So I hope that that's clear. On the website, I will put the vertical lines in where I would typically get in and out. Does not mean you have to follow that. You can, do whatever you want. The other thing I want to point out is I made this particular one a little bit longer to take into account the primary trend, which changed back here when the 21 crossed above the 50, and you can see it changes to green when that happens. This back here was red right there. So now it's in a primary trend. Whenever it is in a primary downtrend, and I'm going to go back 3 years to show you this. So this was the 2022 period. You can see it went into a primary downtrend here where the 21 went below the 50, and this changed to red through here. So you might say, well, you got a green bar above the 21 right there. Shouldn't I have bought and got back in the market right there? Well, you certainly could, but I will tell you that would be a very aggressive move and you'd have to be very careful. You can also see it right here. Same thing happened here. But one of the rules that I go by is if the primary trend is down, which means the shaded area is red, then I do not, remember, this is a long-term trading strategy with a 401k. If it's in a long-term downtrend and the primary trend is red, then I do not pay any attention to these rallies inside of here. I want to wait until either it's getting really close to switching over or till it actually does switch over, which would have been the primary uptrend right there. So that would be the entry right there, not on one of these. So that is just one little modification to the rule. It needs to be in a primary uptrend in order to get in when it goes above the 21. And all through this period right here, it pretty much stayed, except for this little section. It stayed above the 21 all the way up. This is a 21 week, remember. For those that enter after the primary trend is already triggered, then you can wait for something like this, wait for it to pull back below the 21 and then wait for it to come back above the 21 and then get into the trend. So you're getting in a little bit later, but that's okay. You could have done it over here as well. When this one went down below, but it didn't stay there. By the end of the week, it actually closed above it. You could have, again, got in right there, as I was explaining before. If you didn't make it in this one or this one, if you just found out about this up in through this area, said, oh man, I wish I'd been in back here, which is a year and a half earlier, right? So you might have to wait another year and a half for another primary uptrend, which we might have to wait another year for this. But you could have got in here in the middle of the trend and at least caught some of this. So that's kind of the way this works. I make it pretty easy on the website because I actually put the vertical lines in there. You'll see on the daily right here, the daily, first let me go back here and I'll show you down here in the matrix, it actually has a go to cash signal as of today. That's for the short term. So short term, I got 2.2. You know, you saw yesterday it was up 9%. Well, with a huge move like today, gave a lot of that back because we were short, but we are still short on the longer term one. But if you look at the daily, we actually need to have a blue bar in here now. So I'll do that right now. So today we get a blue bar, even though it has not actually closed above the 21, but it was such a violent move that, and you know, we gave back quite a bit of the profits, then I wouldn't want to give back any more. It probably is going to go higher tomorrow. One thing that I made a mistake yesterday, I thought the CPI was today because usually it's on Wednesdays, but it's not, it's tomorrow. CPI comes in tomorrow. So like I mentioned last night, the CPI I think is going to come in better than expected. Actually, the expectation actually moved even a little bit more down. So probably will come in just as expected, which is 2.5. So it's going to go from 2.8 to 2.5. That, in addition to everything else, is probably going to send it higher again. Another interesting rally. Now, today I think was mostly short covering. So with that, let me actually go to the dashboard and we'll take a look at where things are. So you can see right there, right here is pretty much where Trump made his announcement right after lunch. So you can see huge move right there. So here's the announcement right here, right after 1 o'clock, and then the market just took off and never looked back. So I think it's probably with CPI. I think a lot of that was short covering. It was really a monster short squeeze today. That's what a real short squeeze looks like. What happened today. So we'll have to see tomorrow if it will continue. I think CPI will help it to continue, and then we get into earnings and we'll see what happens. Now remember yesterday's topic. Do you buy the frickin' dip or do you sell the frickin' rip? So today ripped. We are ripping right now. I think we still have a little bit more to go. I think we will probably go a little higher, but I still think that we will have more downside in front of us. So there's equities, here's bonds. 20-year went up, came down. You can see right at 130, right there. That's what it's going to look like on most of these charts. 10-year, actually 10-year started right in the beginning, went up and never looked back. US dollar went higher today. Commodities, gold had a nice day. Right from the beginning, gold was up. Silver, which had been struggling, was up nicely. Gasoline was up as well. Gasoline, oil, natural gas, all the commodities were up. Crypto, Bitcoin, 83,000. Bitcoin is still trading, so I think it was at 84 a little while ago. So it looks like it might be coming down a little bit. But everything was higher. Look at the advanced decline lines. Look at that. Nothing but advancers today. 95% in the energy sector, 92% for financials, 92 in industrials. And over here in the sectors, you've got technology and consumer discretionary, 1 and 2. Those are the two aggressive sectors. Communication services, number 4. So the 3 aggressive sectors are up in the top 4. And then the 2 most defensive are down on the bottom. And they had nice days too, by the way. But they're in the bottom of the list, the bottom 10. Staples and utilities, even though they had really nice runs today as well. And then for the industry groups, automobiles and semiconductors. Semis were number 3 out of the industry groups. The top 10, interestingly, MicroStrategy. We'll take a look at that chart. Right at the top. And pretty much gave back all of the losses from the last 3 days, 4 days. So all of those losses, it recovered all of that, sitting right at the 50-day moving average. A lot of charts look very similar to this. I'll actually do a scan in a minute to show you something. So a lot of charts look that way. What else do we have over here? CrowdStrike had a nice day. Cloudflare, nice day. Root had been doing well before. Palantir actually was holding in there even through the downtrend. So Palantir had a great day. Any losers? Let's see. On the downside, let's just take this. This had been up there quite a bit. Didn't lose much. A lot of the ones that came down, that's a major hammer on that one. That one had a losing day, so not too many on the losing side. Most everything was up today, so that's what most of the charts look like. All right, so let's now take a look. Let's go to the website and look at the bottom finder. Very curious to see what that would do today. So remember yesterday, there were 0 stocks looking at the NASDAQ 100. There were 0 stocks above their 20-day moving average. Today, there are 33. That gives you a sense for the kind of rally we had today. You can see the NASDAQ 100 is sitting right at the 21-day moving average. So getting ready to cross over. And at the same time, the 50 getting ready to cross the 200, which would be that would be a death cross if that happens. You'll see all kinds of articles come out as soon as that happens. It's probably going to happen no matter what, just because of momentum. So no matter what, probably by Friday, you're going to get a death cross on some of these indexes. And then you'll see all kinds of articles and things in the press talking about the death cross and that the market is getting ready for a 1929-like depression-like crash. It's not. 50-day, there were only 4 yesterday above the 50-day. Today there's 17. And 37 above the 200. Look at how sharply those have reversed. So this is what the bottom finder typically does. I had some people yesterday talking about, is it time to get in? I've started buying. I nibble at some things. Well, congratulations. You probably are looking really good today. For those that did, buy when you don't want to, buy when there's blood in the streets. That's the time to get in. Look at the VIX, how far down the VIX has come. Now it's still at 32, so it's still above 20. So we're not out of the woods, but look at the put call ratio. This is what I was looking for. Put call ratio way up there like that. Now this is a 5-day moving average, so it takes 5 days, especially with the kind of moves we've had. It takes a few days. You can see these 3 down days right there. It takes a few days to actually get up above into that reversal, that bottom territory, but it certainly is there today. And we certainly did bottom today. Now, the question is it going to last? Will it continue? I think it will, at least in the short term. We'll see what happens when we get into earnings next week. And a lot of companies probably will make their earnings, but they'll have bad guidance. And they're just hedging their bets, basically. Let's look at the market cycles. Look at that. Hit right here, 2 days in a row, hit right here at this support line, right at that Fibonacci, where this Fibonacci started from. And then today it went down and touched it almost to the penny, and then took off and went right back up to this Fibonacci up here. So right back up to the 38% and the 61% level. Very important key levels. And as well, the 21-day is at 5,500. 21-day is still dropping. So momentum is going to pull that back down a little bit more tomorrow. But it'll be right about 5,500. So that is the important one. And right above it is another Fibonacci level. And above that is a really important Fibonacci. So 5650, that's that's a level where I expect we may see some serious resistance right in through there. Take a drink real quick. So keep an eye on this if we continue to rally. I still think you might want to be prepared for a reversal as we get into earnings season next week. And CPI I think is going to come in okay. So it's really going to be earnings that'll be the catalyst the next few weeks. We'll see what happens. Whenever you have a move as violent as this, there usually is some give back. Now CPI might help us to go higher, but I wouldn't be surprised to see a shooting star by the end of the day tomorrow. We'll see what happens tomorrow. All right. Let's take a look at some of the ones we looked at yesterday, like the risk on, risk off chart. See what that looks like today. Well, junk bonds making a comeback, sitting right at the trend line. along with the S&P. This one, not so much, but this one here, high yield versus 7 to 10 Treasury, that made a comeback. Growth versus value, you can see the move. That's actually above the downtrend line. And discretionary versus staples, coming back too, sitting right at the downtrend line. So all of these are clearly indicating a reversal. So we'll see if that will continue tomorrow. I also put a rate of change in here because sometimes you can use that for reversals as well. So you see the 1 year rate of change, the 6 month, and the 3 month down here. The 3 month is the one that goes up the most in a move like this, but you can see all three of these are starting to move higher. So, and you can see that the channel, this is the channel from 2009. This is the bullish channel that we've been in. You can see that it came down and just about touched it right there. And now we're starting to head higher. This is what a secular bull market typically looks like. If this continues to go up, even if it pulls back again, as long as it stays within this channel, then it's still respecting the secular bull market. The channel line touched the 2022 low right back here and starting to move up right now. Let me look at the, let's see, I'm going to look at the secular market chart, see what it looks like today. So this is a monthly chart, so you can see it. Usually when it rolls over like this, it'll take 8 to 10 months for it to reverse and come back up again. So this is a monthly chart, so it really is still going down. It's not really telling us much just yet. We have to see what happens by the end of April. All right, the last thing I'm going to do is I'll run a scan. This is pretty interesting. Let me run a scan using the daily scan bullish reversal candles. So if you remember what this does, it's looking for a downtrend, which we clearly have. It's looking for either a hammer candle or a bullish engulfing. And how many bullish engulfing candles do you think we'll get today? This is what one looks like. This is pretty clear over here. That actually isn't even quite a bullish engulfing because it doesn't come all the way down to the bottom of the red, but pretty close. So let's see what happens. Bullish reversal candles. 152. Huge. And look at the ones at the top. They're all the indexes. So there's a bullish engulfing candle. You can see everything has been at the extreme. This is what I've been talking about through all of my Technical Tuesdays. I explain all of these indicators. You can go back and watch those. I explain this Keltner channel right here and how to use it. I explain all of these indicators through all the Technical Tuesdays. So anyone that wants to be educated on technical analysis, just go back and review some of those. But this is a bullish engulfing candle right there. The other thing that you might notice is this is the squeeze right now down here. This is John Carter's squeeze. If we look at the histogram of the squeeze, we have a higher low. So even as we had a lower low on the price, when it went from here down to here, but momentum actually did not come down as low as that or even lower. Momentum actually stayed up there. That is a bullish reversing positive squeeze. I mean, positive, what am I trying to think of? Everybody out there, I'm sure, knows what I'm trying to say. So that's what you want to look for. You see it here too, again. Let's take a look at some of the other ones. Apple. There's Apple. Same thing. Huge candle over there. I'm not going to look at all of these. I'll just go through a few of them. Amgen. Boeing. Bank of America, which reports next week. Nice recovery. And a lot of these are still below the 21, the 50, and the 200. So they have a lot of ground to make up still. So Citigroup, Celsius, which had been in a nice uptrend already. You can see right here, even with the market coming down, it actually held in there pretty well and came right down to the 21 and then and the 200 and bounced up. That is very positive for Celsius. What else? Costco, nice engulfing candle. Cisco, bullish divergence. That's what I was trying to say. So this is a bullish divergence right here on Cisco. You can see the lower low on the price, but a higher low on momentum. So that's what you like to see. Here's Disney, GE, all of these looking good. Here's Google. Google actually wasn't looking good at all until today. So Google making a comeback. So we'll see if this will continue, but everything looks like, all with this bullish divergence and the way this thing snapped back today, it was ready for that. I mean, it was like a rubber band being stretched and ready to snap back, and that's absolutely what happened today. So you can look at some of these on your own if you want. I just want to see if there's any big ones in here. Microsoft, huge candle on Microsoft, huge engulfing candle. This one recovered 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 days, 9 days worth of losses recovered in one day. Here's ServiceNow, Palo Alto, Oracle. There's the Qs. So all of these look very similar. They all look the same. The big question is, are they going to stay up there? We don't know that yet. We'll find out for the rest of the week. And then earnings start with the banks on Friday. So keep an eye out on that. All right, that's it for tonight. Thanks for watching. Let me know if you have any questions. I hope that I clarified some things on the market timing strategy and how to use that. But please let me know if there are any other questions. I'm more than happy to try to explain that. I know for those that just don't really look at their 401k, the money goes in there and they just really don't pay much attention to it. It is important to understand what's in there, what kind of options you have. There won't be a lot, but there are options. You don't have to keep it in the equity market all the time. Now, right now, probably if it's in there, I would just leave it there because it looks like we're rallying. And we have a cash signal right here for the daily, for the short term. So hopefully that clarified a few things. All right. Have a nice evening, everyone. I will talk to you again tomorrow. We'll see what CPI does in the morning. Take care.